I'm Ryan Lightfoot-Brown of FundCalibre. We're joined today by the elite-rated Richard Colwell, manager of the Columbia Threadneedle UK Equity Income Fund. Thank you very much for joining us, Richard.
Thank you.
Now, you started your career at the Bank of England, just over the road from where we are now. What was your role?
I joined Bank of England straight from university in 1990 in the monetary policy unit, where there was some real super sharp economists and me. One of whom actually was Andy Haldane, who's risen to be chief economist, still there. And then I also worked in the banking supervision area, looking after Midland Bank after it was taken over by HSBC. So what comes around goes around, because they've now got supervision back under their brief, having had a pre-financial crisis. It was obviously split out. So.
And you said that the UK is very unloved, which is damaging global investment appetite. Is this all down to Brexit and Corbyn, or is there anything more happening under the surface?
I think sort of since the referendum in 2016, you've seen an acceleration out of UK equities as an asset class by international investors. But I think it did start before that. And it was really when Merv King stopped his last round of money printing QE that it was a bit past the parcel and assets got reallocated to Japan and then Europe. There's obviously been the currency correction post the referendum results nearly 3 years ago, but I would say that was well overdue because of our current account and fiscal deficits. And I would say, currency's at an okay level now, but whether that still is an issue that is putting off international investors, I'm not sure. But I think it's a lot to do with the fact that there's a perception that outside of the UK things are pretty stable, pretty buoyant, particularly with the recovery in emerging markets in the US. So I would say that could be complacent. And the issues that arose through 2018 was a reminder that volatility can flare up at any time. So, the kind of phrase from old Donald Rumsfeld years ago, we're a known unknown, really. And I think ignoring UK equities or being put off UK equities just because of our chaotic politics would be a mistake, in that the UK stock market affords you the opportunity to buy into a wide range of companies very cheaply, I think. Not just domestic stocks, but a lot of international stocks have also suffered from the outflow you've seen from the asset class. So there's a real good valuation opportunity, I think. So rather than being fixated on the news flow, I think the valuation is the pivot point.
Okay. And you have a think active and act lazy philosophy when it comes to managing your funds. Can you explain what you mean by this, please?
Yeah, I think it's just a good phrase to sort of enforce that investing is not about being frenetic and churning your portfolio a wheeler dealing. It's about quietly doing the work, thinking active, challenging your previous views on stocks all the time, but you don't have to keep trading off the back of it. It's just 1 or 2 new ideas a year, but backed heavily. So it's being lazy, as I say, in terms of dealing, I think is a virtue. You're not trying to generate extra costs for clients by just dealing every day. That's absolutely not what we want to do. What we're doing is something very different as active investors from the kind of quantitative funds that we compete against, or the kind of day trader mentality who are reacting on news flow and sound bites. That's too frenetic. That's not how we're going to add value.
And your equity income funds tends to have a lot of consumer services and industrial companies in it, but fewer resources in financial firms. Why is this?
Yeah, I mean, never say never. There's nothing, I've not got a sort of a mandate that says I will never invest in financials or resources. I just think I'm trying to construct a portfolio that's different from the index, and where I think we've got an edge in terms of valuation opportunities. And I suppose, broadly speaking, I'm sort of saying that commodity area of the market is a big constituent of the index, about over 20% now. But you're kind of reliant on the iron ore price and the oil price, and I don't really have much of an edge on that. And to allocate a big chunk of clients' capital to those areas when they can do it themselves is not where I'm going to add a lot of value. So we did buy the likes of Shell very well after the BG takeover, when it was actually yielding about 10%. Now everybody loves it, it's yielding 5%. So for choice, I prefer to allocate new money into other areas. And financials, again, big part of the index. Nothing against financials per se, although obviously my background's Bank of England and all the rest of it, I think I know quite a bit about banking, and I'm wary of the returns through the cycle you get of banks. So I've got an underexposure, don't own banks. So that's the big difference. And I suppose that's interesting. I think the banks have done a good job in rebuilding capital, but if you like, I think they've almost missed this cycle when getting themselves ready for the next downturn. So I'd be more interested, I think, when everybody's getting gloomy again about banks, rather than now when everybody's going yippee, look at those juicy dividends or whatever. So.
Okay, and on the subject of dividends, Vodafone recently cut its dividend by 40% last week. Is this a sign of things to come? Are dividends under pressure?
I think there's a few things worth sort of flagging. I think that companies, after the bone shaker of the financial crisis, they spent the early part of this cycle rebuilding their balance sheets, and then dividend growth tended to be greater than actual underlying profit growth. So in some companies, some industries, they've got less of a kind of rainy day cushion. So, we're now over 10 years since the financial crisis. So I think it's right to expect that if you do see some pressure in profits and cash flows, then you're likely to see more dividend cuts at this stage of the next stage of the cycle. What we're trying to do with our income fund is smooth the distribution of our dividends as a key part of total return on the fund. So with the reduction in the distribution in our funds when you do get downturns will be much less. That's what we're trying to achieve, and then get on the front foot and collect nice juicy dividend growth earlier in the cycle when it's more healthy. I would say though that a really important point is that high dividend yielding stocks in the market are now extremely cheap, extremely beaten up relative to low yielding growthier stocks. So the market is quite polarised in sort of what it likes. So although within those high yielding stocks, yields of over 5%, it might reflect some distress in current cash flows, but it could also be a great opportunity if you think those cash flows can recover in the way that Shell did post 2015. So I'm not put off per se by owning stocks that may cut their dividends, either because I think that the risk of that cut is more than factored into a share price that has been under pressure, or if I think the company can limbo dance through it and the cash flow improve in the way that Shell or AstraZeneca before it have managed.
Okay, well, Richard, that's been brilliant. Thank you very much for your time. And thank you very much for listening. I've been Ryan Lightfoot Brown, and if you'd like to listen to more of our podcasts, please subscribe to FundCalibre.